Good evening, everybody. Professor Hassey here. Our next to last class session for this summer, week number 7. And we'll be finishing up managerial accounting tonight, leading into budget and finance capital investment analysis in our final week. Assignment number 4 grades will be posted by Thursday of this week if you have posted your work. A final examination guide has been posted to week 7, and I will go over that in just a minute about what to expect in our last posted grade for this course. The final examination will be posted this Saturday, this Saturday, July 26th, and it is due on Sunday, August 3rd. There can be no extensions for the final examination work. Everything has to be posted by midnight, Sunday, August 3rd. Case paper study, as you're wrapping that up this week, we're going to talk about that a little bit this evening. That is due this coming Sunday, but you can get an extension on that work if you need it. And the last possible date for that will be August 3rd as well. But I suggest you get your case paper done before you start tackling the final examination. To do both at the same time could be a little challenging, but we'll talk more about that later. We're going to be looking at a couple of review problems tonight that's going to highlight the work you'll see on the final examination involving chapters 14 and 18, problem 14-1 on page 567, and problem 18-2 on pages 732 and 733. Those very closely and accurately review the discipline of costing and contribution or break-even margin analysis. We began this discussion last week. This is managerial accounting, as you remember, is a way of taking a look at accounting data and apply it to the efficiency and strategies of your company. That also leads into budgeting, which we'll talk about next week. But are we costing and selling our product with the proper profits and margins to cover the additional period or non-product costs that we have in our business? And that's one of the leading discussions of this course. Excuse me, turn off your microphone. Thank you. Mr. Yang, mic off, camera on. Thank you. Maybe speakers on so you can hear me.
但係佢同我講，佢嗰日去玩係有男嘅。朋友啦，係朋友。
I'll take the and mute him myself. Okay. Where was I? Oh, yeah. So we're taking a look at 2 examples this evening of costing and determining our margins. And if any of you work for companies where your selling price is closely monitored to the cost of producing or providing that service, you understand that having the adequate margins and knowing that what that is in your company can mean the difference of making a profit or losing money. And that's one of the key things that are in a lot of the discussions of MBA programs and management programs this summer, is how the administration's use of tariffs is driving companies' management nuts, many companies' management nuts, because the tariffs are going to produce havoc on their margins and reduce their profitabilities. And how can you properly strategize those far enough advanced to avoid any problems? And that's one of the big topics in financial and management strategy this summer, the Trump administration tariffs, or their lack thereof when they say they're going to be. But that's a political discussion that we do not need in this class. Okay, let's see where we are coming into this second to last week of our class. We have completed 55% of the class with your posting of assignment number 4. As I said earlier, I will post those grades by Thursday, so you can see your cumulative average in the course heading into the last 45% of the grading. 20% of that is due this coming weekend, the case study paper where you're doing a financial analysis of the company you have selected in this course. And the final examination, which we'll talk about tonight, which is 25% of your grade, which covers mainly these last 2 weeks of the class, but there are questions assigned, and we'll talk about that if you happen to download the final examination guide that I have posted. Course evaluation link is now posted where you can complete your course evaluations, but that's probably a little bit too early. You should wait probably to the last week or after you complete the course to do those evaluations. One of the key things, I might have mentioned it earlier, is that if you complete your course evaluation and you let me know, you send me an email saying that you've completed it, I will give you 5 extra credit points added to your final examination grade. That's 5 free points, which could mean the difference between an A and an A minus, or a B plus and an A minus, or whatever. So if you complete your course evaluation, you have to send me an email. I do not have access to see who has completed them or not. So you're on your honor society to let me know you've completed it so I can properly credit you on the final, those extra 5 points. So that's where we stand heading in. We have 2 grades left, the case study paper, which you're completing this week, and the final examination work, which is due the last day of our class, Sunday, August 3rd. If you go to week 7, your file folder, you'll see the agenda, what we looked at. You'll see some necessary review PowerPoints and that sort of thing. But more importantly, you can download the 600A final examination study guide. This study guide explains to you what the final is going to be when I post it next weekend. It's going to be 3 sections of our final covering our course. A multiple choice section with a quarter of the grade, which will cover chapters 1 through 3, definitions and calculations from assignments 1, 2, and 3. I'll basically take some multiple choice questions defining the accounting cycle, and you'll be doing some work in those multiple choice formats, which is a quarter of the exam. Another 20% of the exam will be in section 2, which is going to cover the interpretation of financial statement analysis, mainly discussed in assignment 4 that you recently completed. That's covering chapters 12 and 13. Those are fill in the blank short answer questions concerning assignment number 4. And then the major part of the exam, which covers these last 2 weeks of the class. Tonight's discussion on chapters 14 and 18, next week's discussions on chapter 20 and 24. Some highlights of that, which represents 65% of your course grade, Yes, 65% of your course grade. What is the difference between financial and managerial accounting? Defined cost volume analysis. We'll be talking about these tonight. More specifically, break-even analysis, target pricing, variable, fixed, direct, indirect, product, and period costs. Those definitions. What is the benefits for budgeting? Why do you budget? It's the major component of a company's financial strategy. You plan well in advance what you plan on spending, what you plan on taking in revenue. That drives your valuation of your company to provide profits and returns to your investors. And then finally, the last part of that exam section is define a capital budget analysis, net present value, internal rate of return, profitability index, and payback investment analysis methods. These are all in capital budgeting analysis takes all the information you have from your accounting information, and you plan a strategy of where, if you're going to make an adequate return on investing capital in an asset. This is from chapter 24, and we'll look at samples of that, and they've already been posted in week 8 that you can look in advance and see how that all works, and we're going to be reviewing that next week. Everything that we've done, weeks 1 through 7, lead up into finance and week 8. And that's the purpose of this course, why it's called Accounting and Finance. It all serves a purpose of providing management information for a company to become efficient and provide adequate return to their investors. And finally, in this final examination study guide is the course evaluation links. So you match up your CRN code, which you all should have. Is it 1059, 1282, or 1331? You click on that evaluation link, and you can answer a series of questions and give us feedback about the quality of the professor, moi, the quality and value of the course, and any suggestions, both positive and in many cases negative, that you have about the course or the MBA study. It's kind of not very fair to you to do a proper analysis when we're giving all this information in a span of 8 weeks. I guess the fair thing, though, is did you feel that you got enough information to make this course worthwhile? And hopefully, if I did my job properly, you did that. But if I didn't, that's a form of letting me know. One of the first things I do when this course completes is get the completed evaluations and I review them. I don't know if I can say that about many professors at Laverne, but I specifically do, and I find them very informative to give me an idea. Also, the dean of our College of Business, the department chairs of accounting and finance, and the provost of the institution all review these evaluations. So your voice is being heard and interpreted when you complete these evaluations. I know a lot of students sometimes don't bother because they don't think their information, good or bad, is being listened to or heard or accounted for, and it is. I can trust that. This university does a pretty good job in looking at institutional feedback from their students. So those are the links. These links are also located in week 8 file folder as well. So once you feel ready, click that on, complete it. It takes about 5 to 10 minutes. And then you send me an email saying, I have completed the evaluation, Mr. Hasse, and then I can add the 5 points to your final examination grade. So take a look at this study guide. It's pretty broad, but it gives you an idea where the questions are coming from. If you have your work, which you all do, from assignments 1, 2, and 3, those are study guides, and assignment 4. And then the material that we're covering this week and next week are on the final examination. In most MBA classes that I've ever been associated with, usually you don't have final examinations because you usually have case studies or case papers. You have a case paper, but a smaller version that you're doing this week. But because of the nature of this class covering so much material, and it's only 8 weeks, in order to properly assess the nature of the material in this course, the final examination has to be made. So if I was an MBA student, I go, what the hell has to give me a final examination? What is this? Undergraduate study? But that's the way it has to work out in order for us to assess and give you feedback on the materials of this course. Okay, enough of that Chamber of Commerce nonsense. Let's move on. Anybody have any questions on this? But as you go forward in the next week, if you have questions, be sure to let me know. But this is designed to cover basically all the material that we've covered in the 8 weeks of our course. All right, I'll be looking at these two review problems, and I'll be posting the solutions after class tonight. But they pretty well represent the material you need to be familiar with chapter 14 and 18. Review problem 14-1 on page 567, as I said earlier, and problem 18-2 on pages 732 and 733. For some of you who don't have text, you just click on this and you can follow the problem. This is just a PDF of the problem. There it is right there. And then we can go over the solutions and review those solutions and study those solutions tonight. So there's 14-1. And 18-2 right there. So those give pretty good representation of what you need to know out of these managerial accounting sections of our course study. And we'll be reviewing those in just a few minutes. I will post the solutions as we complete them after class and you have them. So you can just take these. If you don't have a text, just go to the top, click the down arrow and download them to your computer. And now you have them as a study guide to review this work in preparation for the final examination questions. So those are the two problems that we will be looking at that act as review for this material. Okay. Let's see, any other administrative things I need to talk about? I don't think so. Okay, I think we're all set. All right, so let's take a look at this problem from chapter 14 that gives a good idea of what costs are. Here's the problem on page 567 of your text. And this is also on week 6 of our file of our D2L website. Listed here are the costs associated with production of 1,000 drum sets manufactured by a company. Plastic, wages, property taxes, accounting salaries, drum stands, rent, office management salaries, annual fee for factory maintenance, which is probably janitorial services, sales commissions, and factory depreciation on the machinery. And it gives all the prices involved, costs. You are to classify those costs between either, is it a product cost or is a period cost? Remember from our discussion last week, a product cost is associated directly with producing the product or the service that your business is all about. Those costs associated with production or providing a service, naturally, if you're a service organization. And those three costs are labor, materials, and overhead, directly associated with the product. And those costs have no time limit. They are costs put into inventory, and then that inventory can go over multiple fiscal periods, and they can become an actual operating cost once that inventory is sold and becomes a cost of goods sold. So product costs have no lifespan. They can go from period to period, which makes that kind of interesting. Well, yeah, I guess it's interesting. But period costs do have a time period. Those are non-product or non-production costs associated with non-manufacturing or non-service oriented parts of your business. And they go for a fiscal year. They go from January 1 to December 31st. Those are period costs. They're not in inventory. You don't inventory a period cost. They're called operating expenses, or some companies like to call them G&A expenses, general and administrative expenses. So here's a quick problem to say, okay, Mr. Hassey, what is a product cost and what is a period cost? The second section is compute the average manufacturing cost to produce a drum set. What does it cost them to produce a drum set when they're producing 1,000 drum sets? This is a typical calculation used by managerial accountants within companies What does it cost us to produce our product? Because why do you need to know that? Because then you need to sell that product for a lot more than the product cost or the cost per unit to cover your margins, which leads us into the second problem that we're going to be doing tonight. But first of all, let's make sure we understand what costs are and how to designate them. No period costs are going to be involved in the manufacturing cost per drum. It's all product costs. Because remember, period costs are administrative costs, not associated with the cost of the product and the inventory that that product will be in. Okay, so let's just go down the list. They start off with giving us the first one, plastic for the casing. Okay, you're making drums. You need plastic to produce the drum. All right, that's a product cost of $17,000. That's a pretty easy. Wages of assembly workers, $82,000. That's a product cost as well. Why? The key word there is assembly workers. They're actually putting together the product, the drum set. So that's a product cost, $82,000. Property taxes on the factory. That also is a product cost. Why? It's an overhead or indirect cost of production. You have to pay taxes on the factory where your drums are being built. $5,000 is a product cost. Finally, we get to a period cost. Office accounting salaries, $35,000. The key word there is office accounting. They have nothing to do. They don't put together the drums. They are the administrative forces of the company. So that $35,000 goes into period costs. Drum stands, $26,000. Yes, we're making drums, so I would consider the $26,000 of drum stands a product cost. Rent cost of office for the accountants, $10,000. Again, no mention of factory, no mention of production. I assume this is a period cost having to do with paying the rent for where our bean counters all hang out. $10,000 period cost. Office management salaries. Now, here we go. This is where all the high rollers make their money. Office management salaries, $125,000. Period costs. The key word there is office. Office. They have nothing to do with the production. Yes, they kind of oversee the strategy of the company, but they are not producing the drum set. They're period or G&A costs. Annual fee for factory maintenance, $10,000. This is a product cost. Why? Because it's in the factory where you make the drums. It's the probably, I would assume, maintenance on the factory. I assume that's janitorial service. Cleanup of your production facility. That is a product cost added to the cost of manufacturing a drum set. Annual fee, oh, so I got that. Sales commissions, $15,000 of period costs. We talked about this last week. Period costs, $15,000 for sales commissions. How do we encourage our marketing or sales team to sell the product? We give them a commission. The more they sell, the more money they make. And then finally, factory machinery depreciation, straight line method is used, $40,000. Again, the key word there is factory. Factory. Machinery depreciation, that's a product cost, $10,000. $40,000. Okay, so we've designated what our product, what our period. So let's go in and see what this all looks like. Well, there we go. We designated the cost by product and period, which we just did. And now what we do in part 2, we now just take all those product costs, casing for plastic casing, wages for assembly, property taxes on the factory, the drum stands, annual fee for factory maintenance, factory machinery depreciation, $180,000. We're producing, all these costs are associated with producing 1,000 drum sets. So the cost to produce one drum set for this company in this period of time is $180. Notice office accounting salaries, rent on the office management salaries, sales commissions are not determining manufacturing cost per drum. Now, why is that $180 so important to us, MBA students? Well, let's say this company is selling their product in the market for $170. Whoops, somebody goofed. In addition, the cost of manufacturing of $180 is not even coming close to what they're selling it for. Plus, they haven't accounted for or covering these period costs that the company's incurred as well. So remember, when a company determines the cost of manufacturing a drum set, they want to make sure that their retail price per drum is far north of $180, so they have that margin to cover their period costs and make a profit as well. So that's why this is so important. Mr. Griffin, a question. Mr. Griffin, you have a question.
Sorry, I'm sitting here talking on mute. My apologies, sir. My question was, how does this relate to, and it's probably beyond scope for this class, but say a company is buying on credit and they have like something like a net 20 or net 30 or something like that, or they get a discount for paying earlier, or how does this, and then how can we look at discounts that may be applied for someone who's purchasing in large bulk and reaching economies of scale, and how does that impact this equation? Are we just worried strictly about these are just the numbers right now, or do we factor that in later on in the accounting process?
No, if you're talking what you're doing there, Jason, is let's say the drum stands cost $26,000, but they actually cost them originally when they placed the order with the vendor who's providing those drum stands $28,000. So when they paid for the drum stands, which was owed $28,000, but if they paid within a discount period, maybe they got a $2,000 discount from the vendor. So the final cost of those drum stands, less the discount, is what the cost goes into this number here. So you're probably assuming that that discount, as you say, will be included in any of these numbers.
Okay, all right, thank you.
Does that make sense?
Yeah, that makes perfect sense.
That's right.
Definitely.
Very good. Good question. So that's why we're determining manufacturing cost per unit. And I assure you, at any company you all work for, if you're providing a product or providing a service, somebody at your company knows exactly to the penny what it costs them to provide that service. For example, at the University of Laverne, for an MBA student like yourselves, our CFO, Mr. Kashishian, knows exactly what it costs the university per student to provide you an MBA education. Trust me, he knows that. Does he tell anybody that? No way. But he knows that number because when they determine your per credit hour tuition for the course, that is enough of that tuition credit hour to cover those costs of providing you an MBA education. If any of you work for a service organization, a not-for-profit, or whatever, somebody at your organization, well, if somebody's not doing this, then your organization is run very poorly and is not going to last very long. But somebody knows what it costs you to produce your product. Here in this company, they know in this particular accounting cycle, it's costing them $180 per unit. That is huge. If you go to work for a company, or if you're a manager, or a company hires you to be a supervisor of a department or a division, and when you're in the interview process, or when you start your first day of work and you get all the employees together, the first question you should ask is, okay, what are our costs of production? What is our budgeted cost of production? What do we plan on paying to produce 1,000 drum sets? And that's what we'll talk about budgeting next week. Okay, let's take an example of that example here. Let's say in this company, their budgeted cost of producing a unit is $170 to produce one drum. Well, in this cycle of accounting costs, it's costing them $180. The next strategy for that company is to determine, why were we off in the budget process? What happened? And as I said earlier in this class this evening, what probably happened, the budget was probably done 15 months ago. Now 12 months have gone by, the cycle is completed, and we're spending $10 more per unit. Why? Geez, last February, Donald Trump hit our industry with tariffs. Our drum stands are built in Vietnam, and he charged a tariff on those goods coming into the country. So we're passing on those costs as a cost of production. We did not know we were going to have tariffs when we did the original budget. Thus, our costs are $10 more per unit because of that change in our costs over the operating year. And that's what I mentioned earlier. That's what's happening a lot now in the economy. And it's driving companies bananas. You usually, and many of you probably work on budgets at your organizations. Many times budgets, for example, right now, we're now in July of 2025. I'm almost positive that any company who has their fiscal year ending December 31st, right now in July, is working on and probably close to completing their operating budget for 2026. So they're working on their budget now, and now that budget is going to apply to their actual costs once the budget year begins on January 1 of 2026. So that's a 18-month time period. A lot of things can go wrong or happen in that 18 months. And for efficiency within organizations, they need to have these efficiencies monitored and studied to make sure they can see changes in their costing to the budget and how that affects their profitability. If they don't, they're going to be in big trouble. And that's why companies are really concerned about these additional costs. Forget the tariffs. How about the cost of fuel? How about the cost of people? Fringe benefit costs? All these change. And can you, 6 months ahead of time when you're doing your budget before the fiscal year begins, can you get a proper handle on what those costs will be in your budgeting process? That's a tough call. And that's why gathering this information, gathering these data is so important. But it starts off as what we're doing in this problem in chapter 14. Okay, what are our product costs? What are our period costs? What is it costing us to produce this drum set? $180. Okay, those are key components. Now, not discussed in this problem is what we're going to look at in the problem 18.2. How do we add variable and fixed costs to this analysis? Variable and fixed, because when you're talking variable and fixed costs, you're looking at contribution margins. And that's what chapter 18 is all about, cost volume analysis. But forget that for now. This is a perfect example of determining costs of product and period, and what does it cost us to produce one drum. I actually did this many years ago. and it's kind of cold, but it made sense to me. My wife thought I was totally bonkers. I determine what it cost us to have one kid. What does it cost to have a child? What does it cost to have a child? Medical, education, food, all that stuff. Now, I wasn't very close in my analysis, but I tried to do that. Because if we decide to have one child, two children, three children, is our revenue going to be able to provide a good background, a good solid base economically to have a child? I know this sounds kind of cold, and I apologize. I'm not this type of person, really. But applying business sense, managerial accounting sense, what does it cost to have a child? And there are people and there are organizations that get this specific of understanding this. Okay. Anybody have any questions about this product period calculating? Notice when I ask you to calculate manufacturing cost per unit, all you include are the product costs of that production. No period costs are included. Any questions? Okay. Very good. Let's look at our next problem, where it takes a look at this a little bit differently. And that's chapter 18. Problem 18-2 at the bottom of page 732. Again, if you don't have a text, don't panic. This is right in your week 7 folder, so you can see that. Now, this is taking a look at costs a little bit differently. In the problem we just looked at, we were looking at product and period costs. All right. What costs are associated with manufacturing the product? In that case, was a drum set. And what costs are G&A, administrative costs. Now we're taking a look at the 1,000 drum sets by variable and fixed costs. Variable and fixed costs. This is the same problem, but we're looking at a different way of interpreting this information. We're trying to determine the contribution margin of this product. So let's take a look at this. It's the same problem. Notice the costs all look the same, but now we're not allocating them by product or period. We're allocating them by variable and fixed. And they tell us in the problem that this company sells these drums retail for $300, excuse me, for $500. Remember back in problem 14.1, we saw that it cost us $180 a unit to produce those costs, those drums. Now they're telling us they're $500 retail. So it looks like we got that covered. The problem is we're now trying to find out what is our contribution margin per unit. Remember, the contribution margin is the difference between selling price per unit and variable costs per unit. Selling price less variable cost, because those variable costs change with volume. And is the margin between selling price and variable cost enough to cover the costs that don't change according to volume? You can produce 2,000 drum sets or one drum set, you're still going to have all those fixed costs. And that's what we're looking at here in this problem, a different way of looking at the numbers. And this is what managerial accountants do all the time. Okay, what our product costs, what does it cost to produce it per unit? What are our period costs? Okay, those are our operating expenses. All right, but now, are we selling this product at a price that's giving us enough margins to make an adequate profit? So as you can see, the variable costs for this drum set are costs that are related to volume. Volume, not period or product, but volume. The more you sell those or produce, those costs will go up. Plastic for the casing, a variable cost. Wages for the assembly workers, a variable cost. Drum stands, a variable cost. Sales commissions, there's a period cost, that's a variable cost as well. All those four costs, if we produce more drum set, those total dollars will go up. If we produce and sell less drum sets, those costs will go down on a total dollar basis. Let's look at the other side of the coin. Fixed costs. Taxes on the factory, factory maintenance, factory depreciation on the machinery, the lease of equipment for the sales staff, accounting staff salaries, and administrative salaries. All those are fixed. They do not change with output. They stay the same. So now that we have those designated, variable and fixed, the same type of costs, we're just looking at them in a different way. Now we can prepare the answers for this problem, a contribution margin income statement, and what is the contribution margin per unit and contribution margin ratio. This also is huge for the efficiency in the management of a company. So let's take a look at how we do that here. First of all, here's part one. Here's the contribution margin income statement. And this is listing the variable costs and the fixed costs as cost centers. There's our selling price. Remember, they told us in the problem, we're selling 1,000 drums at $500 a piece. That's $500,000. Then they tell us that we have variable costs of $140,000. Those are those four variable costs that we just talked about. Notice sales commissions is there, and that's what sometimes gets students very confused. Mr. Hassey, why is sales commissions a variable cost and lumped in with plastic for casing, assembly workers, wages, and drum stands? The key thing there, this is not an analysis of product and period costs. It's analysis of costs that change by volume, variable costs, and sales commissions go up and down by the more units you sell. So our contribution margin here in total dollars is $360,000. That $360,000 has now got to cover all our fixed costs. Taxes, everything in factory, administrative, and all those fixed costs that we just talked about, $225,000. So looks like we're making money. Our contribution margin is high enough to cover those $225,000 fixed costs. And we're making a net income of $130. Now, on a per unit basis, this is what part two is all about. Our contribution margin per unit is $500 selling price and minus 140. How did we get the 140? 140,000 divided by 1,000 units. Our variable cost per unit are $140. So our contribution margin per unit is $360. $360 is 72% of our selling price. That's pretty good. The higher the contribution margin relationship to the selling price, that means you're going to get to profitability pretty quick. That's good. If you have a contribution margin percentage in the low 40s or 30s, you're going to have to sell a lot of units to cover your fixed cost and cover your profits. But here they're in pretty good shape. Now, while we're on this page, let's take a look at something. What is this company's break-even point? How many units in sales do they have to sell to cover their fixed costs of $225,000? In other words, how many units do they need to sell to make zero profit? All right, well, let's bring up something here. Let's see if I can do this without driving people crazy. I'll do it this way. Okay. Let's take a look at this. Remember, the contribution margin is the selling price. Oops. Just a sec, give me a moment. All right. Now we're cooking with gas. Here we go. Okay. Our selling price is $500. Our contribution, our variable cost per unit are $140. Thus, we have a contribution margin of $360 per unit. Our fixed costs total $225,000. I think that was right. Is that right? I think so. So what is our break-even point in units? Well, it's the break-even point in units is equal to, this is not asking the problem, I'm adding this, is equal to our fixed cost, 225,000, divided by our contribution margin per unit, $360. So if we do the arithmetic, 225,000 divided by 360 is 625 units. So we sell 625 units, our cost or our profit, our net income is zero. Well, notice we're selling 1,000 units. So that's a pretty good margin of safety. 625 units versus 1,000 units, that's a pretty good deal there. So in other words, at 1,000 units, we're making a profit of $35,000. So the company knows that their margins are pretty good. Remember, our contribution margin percentage was 72%. That's pretty good. So we're getting to profitability quickly. We only have to sell 625 units. Once we sell 626 units, we're making a $360 profit. We sell 627 units, we're making a profit of $720. Our contribution margin, this $360, becomes our profit margin once we reach our break-even point in units. So if we're 625 units, so the difference between 1,000 units that we sold and 625, which are break-even point, is 375. If we multiply 375 times our contribution margin of 360, we get $135,000, which is our contribution margin and our net income. So this is a good analysis of why companies do this, to see the relationship of their variable cost to their selling price. And is that relationship a high percentage, a high margin to cover those fixed costs that they need to cover in order to get to profitability? That's why this is huge for most businesses. If any of you are going to be an entrepreneur and start your own business, and you're going to go to a bank for a loan, or you're going to go to investors asking for a capital investment, the first thing that bank or those investors are going to ask you, what is your projected break-even point for your business? How many units do you need to sell to make money? And the next question will be, what's your contribution margin? Well, I know it for a fact that Wells Fargo Bank, if you go in to take a business loan on a startup company and your contribution margin ratio is under 50%, they ain't giving you any money because your margins aren't high enough to avoid the risk of you not being able to pay back that loan. It's kind of like a FICO score for us individually. If your FICO score is 700 plus, most banks are going to give you credit at a pretty cheap interest rate because they know you pay back your money. They have a good reputation. Well, the same thing in business loans. You have a credit rating, but also in business loans, the bank wants to know, are you available to cover your loan? What's your margins or what's your profit so you can pay that money back? And the higher the contribution margin percentage, the easier they'll give you money for a loan. As I said earlier, if you're under 50% contribution margin, that's trouble. Let's take a look at that in this example. If my margin was 50%, that means my variable cost per unit is $250. That's 50% of the selling price. That means my contribution margin is $250. Well, if I take $250 divided into my fixed costs, how many units do I need to sell to cover all that? Well, if I take 225 and divide it by 250, that's 900 units. That's 900 units. I'm still making a profit at 1,000 units, but not as much as I was at the variable cost or the contribution margin at 72%. So that makes a big difference. And a lot of companies watch that. Going back to our original work on this problem, 72% was 360. So that's 140 and 360. Selling that at divided by 360, and that's how we got the 625 units. So they don't have to sell that, well, they do, but they don't have to sell as much to get to profitability. And that's what investors, that's what managers, that's what bankers look at to make sure they understand, is this company viable? Are they going to be able to do this? So that's why this makes sense, these two chapters here, 14 and 18. It helps us taking accounting information about costs, product, period, variable, fixed, and apply that to, are we making money, and what do we have to do to make more money? What are our margins? How do we fix our margins? And in the case of what we've been talking about, all of a sudden you have tariffs thrown into your company's mix, and those tariffs lower your contribution margin percentage. That means you're going to make up for that. You got to sell more. And if you're in a down economy or your industry's in a downslide, that could be the difference between making money and losing money, or laying off people, or moving away out of America and go to another country. And trust me, a lot of companies are looking at that these days. Okay. Why is the Trump administration doing this, tariffs and costing? Because they want to bring those products back to be produced in America, not in foreign countries. They want to make sure that they want to have those products built in America. It gives wages and jobs to American citizens. And that's the main reason why he's doing it. Some people agree with that. Some people don't. That's your reference. But as a businesswoman and a businessman, you need to know how that all works so you can make effective strategies and decision-making in your business. Okay, I'm going to save this so I can put it in my notes for the class. There we go. So those are the two problems that pretty well describe what you need to take out of chapters 14 and 18, those two problems. I will post those solutions after class tonight, so you have that as a study guide, but you need to be familiar with how to designate manufacturing cost per unit by determining product against period costs, and what is our contribution margins or our break-even points, understanding the relationship of your cost to variable and fixed. That's the bottom line. And we have a whole class at Laverne undergraduate. It's called Accounting 202. The whole 15 weeks is doing nothing but studying this. You guys are doing it in 2 weeks. It's a little bit different. But that's how important this is to a management your company. Okay. Now, when we come back from a little break, we're going to now apply this to the budgeting process. Like I mentioned earlier, many companies, it's July, are working on their budget for next year, 2026. You have to plan that far ahead, making sure you can plan your budget. Why do you plan the budget? So you can see when the actual numbers come in 2026 to produce these drum sets, that they're matching what you thought would happen in your business. And your margins are being what you thought they would be. And if they're not, what do you have to do to fix that? To monitor, to adjust. And that's what budget planning is all about. Chapter 20, we're going to talk about that a little bit and apply it to this discussion of managerial accounting and cost volume analysis to our study. So let's take a nice little break. I'll see you guys all back, since you didn't give you time, you guys, to turn on your cameras when you come back. I'll see you at 7:15. Adios. We are back. Alexandra, I hope your kitty gets okay.
Thank you, me too.
You get so attached to the damn things. It drives me nuts. Okay. I'm sure a lot of you in your jobs where you're working now, part of your dealings in your company involves a budget. Some type of plan or some type of budget in your department, in your office, in your division, wherever. You probably have a budget. Budgeting is a key part of managerial accounting because it allows you to plan for future business actions and expressing them, get them out there, have different eyes on them, different people to see them. It's a formal statement of a company's plans in dollars. What do we propose to do? Revenues, expenses. And why is that important? Because if a company is not organized to plan efficiently, you're not going to get any money. You're not going to have any investors. You're not going to have a viable, sustainable business if you don't plan. It's to set the objectives and the goals of your organization. That's what a budget is. And it's very important to the process, and it's taking accounting information and applying it to a plan, a strategy. Now, some companies are very specific with budgeting. They spend a lot of time on it. Other companies, it's not that big a deal. It's the culture of the company. And it's the competition or the industry that you're in. If your margins are really thin, especially like in the retail business, Target, Costco, Sam's Club, Walmart, their margins are really thin. In other words, the difference between profitability and loss is based on how you react to your competition. And if you don't plan that, you're going to be in tough shape. So a budget is a plan, it's a control, it's a coordination, it's a form of communication, it's motivation to your employees. It's all these 5 areas. Those are the benefits of budgeting. It allows you to communicate strategic plans to all levels of the company, and that is huge. It can be very positive and motivating for an organization to have a budget that everybody understands and knows that they participate in. They're of value to the company. But also it can provide negative areas of a company. They might not understand what the company is trying to do. What are the objectives? If they don't meet the budgetary results, sometimes employees do unethical behavior, commit fraud. Boy, we're way under budget. I got to get going on this. And you might promote bad behavior. And that's where supervision is key. So there are positive and negative attributes to why companies budget. A lot of companies use what is called rolling budgets, quarter on quarter. Some of them use yearly budgets. It depends on the culture and depends on the organization and the leadership of the organization. Many different ways a company can attack planning. Some companies were popular during the 80s and 90s called zero-based budgeting. In other words, you start every year like you're a brand new company. Start from scratch every year. That tends to wear out people. Tends to drive people, overwork people. So some companies don't do zero-based budgeting much anymore. This is what a description of what a master budget is for an organization. It takes sales. It takes operations. It takes financing and cash flow management and capital fundraising and expenditures. It's a combination of all these areas to produce a plan or a strategy into the next year. And many companies budget, when they do a budget, they go 1, 2, 3 years out. Not much longer than 3 years though, because then you're guessing. It's pretty difficult to, especially when you think about your own everyday personal finances. Can you really think what you're going to be spending and how much it's going to cost in 3 years? That's a difficult thing to do. But you can do 1, 2 years out very efficiently. You can do a plan or a balance sheet. What do we expect to look at? And this is big for investors. A lot of investors say, okay, how much cash flow are you gonna have planned this next year? Are you gonna need to borrow much money, short-term or long-term? So all different types of budgets can be done. For us, we're gonna be concentrating or mainly concentrating on sales and expenses. Usually you budget on a monthly basis and break those months down by quarters. Here's what we plan. Notice in this company here, December is when you're selling most of these hockey sticks. Why? It's the wintertime. More people are playing hockey. We all have different cultures within our companies that drive the budget. Some companies, their budgets are high in the summertime when people are on vacation or doing traveling. Other companies are in the fall, buying school supplies, buying computers, whatever. But whatever you do, you try to accurately base your sales budgets on the past, what you've done in the past, and what you see the market into the future. And this is why a lot of us study marketing, how to read our market, how to read our industry. What are our competitors up to? That's a big part of budgeting. Production budgets. Once we have our sales, all right, how much are we going to need to produce? How are we going to meet those sales demands that the marketing people tell us that we're going to need? How do we produce? How many do we produce? How many do we keep in inventory? That's a big area of budgeting, production budget. Here's our sales. Remember, we in the sales budget, we're going to sell $1,800 and $1,400 units in those months. All right. How many units do we need to produce those months? How much do we need to produce those during those months? Remember, we have inventory coming into the period. So we're going to have to produce a lot more in November because our inventories was down. So this is a big area of budgeting that a lot of people don't think about. Oh yeah, we're planning on selling 1,000 units in October, 800 in November. Why don't we just produce 1,000 units, 800 and 1,400? No, because remember, production costs are based on product costs, which are inventory items. Some units stay in inventory, you don't sell them. And if sales pick up, you have to produce more to meet those sales demands. So you have to understand in production, it's not only the cost of production, but the inventory levels that you have to maintain. You have to maintain material budgets. How many, if any of you know a purchasing agent at companies, purchasing agents have to make sure they have enough materials on hand so you can build your product. Sometimes you're ordering materials 2 or 3 or 4 months or even 6 months before the budget cycle begins because you have to buy those units and have them sent to you. If anybody remembers the pandemic, and a lot of you might have, of the supply chain issues, of getting supplies of materials and products. And those supply chains, a lot of companies learned a lot about supply chain management during the pandemic. And now the tariff situation is adding to the supply chain troubles for many companies. How do we produce and find the necessary materials to produce our product? And this is what a direct materials budget is. That also relies on inventories. I'm not going to ask you to prepare all these budgets. That's crazy. But I just wanted to show you the general definition of what the budgeting process and the planning process is. And that's the key to chapter 20. Just understand. What are our labor costs going to be? Are our labor's costs going up in the next quarter? Do we have a new contract? Is our production levels going to be increased, so we're going to have to maybe pay overtime to some people? The better you plan for that, the easier it is to manage. A lot of companies, and a lot of you probably know this, no overtime, because that's time and a half, double costs. You don't want your employees to work overtime. So you try to plan efficiently your labor force to make sure you cover the production demands without going into overtime. And if you do go into overtime, then you better make sure you sell those products and pass those costs on at retail. That's where companies get in trouble. Oh, geez, our sales quotas are way up. We're producing a lot. But when you produce a lot, maybe you're working on a lot of overtime. Maybe your supply chain management system is slowed down, so you got to pay higher for materials to get those materials to production. So these are all important areas that you try to plan and act accordingly. How much labor does it take? So you can imagine just taking a look at all these just so far: labor, materials, production, balance sheet, revenue, sales. To have an efficient budget process, you have to have an efficient integrated computer system. Tell you a little bit a story, I'll tell it on the record, but one of the reasons why Laverne is struggling these days is we have antiquated accounting systems. We don't get the right data when we need it. And our CFO is aware of that. We just don't have the capital needs to go out and buy efficient software to manage our business. And that's slowing us down. That's not providing accurate data to manage the business. And a lot of companies struggle with this. It costs money to have these systems to keep track of all this. And if you don't have that capital investment, don't have that cash flow to buy these systems, your data and your analysis is going to be threatened. I can't tell you, one of the big fields now in business is data analytics. But if you're not getting the data, how can you analyze it? And that data comes from accounting systems, production systems, purchasing systems. If you don't have up-to-date data, all the analysis you do is going to be wrong. And I'm sure some of you deal with that in your own companies. A lot of companies don't keep up to date with their infrastructure as far as IT because it's expensive. Jason, question.
Wouldn't something like, and correct me if I'm wrong, but like, isn't that why companies invest in ERPs like enterprise resource planning suites to kind of help with this and kind of incorporate all the different attributes into running the actual organization, as far as things like this, as far as like cost accounting and budgeting and all that kind of stuff? Or am I conflating the two?
No, that's exactly right. That's a good point. If in order for your business to be efficient and you can be efficient in the management of your numbers, but also you have to be efficient in understanding what it takes to be competitive in the industry you're in, what it takes to be competitive with your competitors. And if you're not getting good data or timely data, you're in a losing proposition. You're going to be guessing. What's the expression a lot of people use? You're just pulling numbers out of the air. Oh, okay, we'll use that. And you might be right, but you might be wrong with those numbers you're pulling out of the air because you're not getting accurate data. It's just like, can you imagine in your own personal finances if you do not know the balance in your checking account because you don't keep track of it, or you don't have an efficient system to keeping your balance in your checking account? And how do you pay bills when you're thinking, oh, geez, do I have enough money to cover these bills? That's crazy. You're either something's going to happen, you're going to bounce a check, or you're wasting money because if you have a lot of money in your checking account, why don't you invest some of it? You don't know where you stand. Well, that's the same thing what I'm talking about, what Jason is mentioning here with company. If you don't have efficient data management, you can't manage efficiently. And that's a big driving force with companies. Huge. Keeping track of overhead costs. Having a budget for planned product costs. Remember in the drum case we looked at in chapter 14 and 18, they're producing drums, what the costs are. Well, how about a budget Is our plan exactly what our costs are? Are we planning our budgeted cost per unit is what is our actual cost per unit? And if it's not, where are we off? Why are we off? Is our budget process wrong? Or we're not looking at the correct way to interpret our actual costs? Huge. Cost of sold. Selling expense. See, it goes on and on. Cash expenditures, capital budgeting, on and on. And I'm not asking you to know all this, but that's one of the things that's a little intimidating about chapter 20 is, geez, I didn't realize there was all these friggin' budgets we got to watch out on. But this is what the CFO does of a company. And here's perhaps, and this leads us into our financial discussions of next week. Do we have, and are we managing, or do we have enough cash on hand to run our business? And when we don't have enough cash on hand, do we have to go out and borrow money short term? Do we have to go out and find additional capital when we have cash shortfalls? And if you're going to be an entrepreneur or run your own business, this is the biggest sticking point in small businesses, cash management. Do they have enough cash to meet their payroll, to meet their taxations, to meet their vendors? And if they don't, how do they manage that? How do they keep track of it? And the cash budget is huge. Think of this in your own personal financial management. Your cash budget will be, okay, every month I bring home $5,000 after taxes. All right, that $5,000 has got to last me to pay rent, car loans, insurance, education, food, clothing, put a little bit in savings. Okay, I can manage that. But if you can't manage that and you're constantly using credit cards to fill in that gap, here, this preparing cash budget down here, notice it says a line of an additional loan. Well, they don't need to because they have plenty of cash. But when you don't have enough cash flow, you have to borrow money. And as individuals, where do we borrow money? Most of us, we use a credit card. That supplements when we don't have enough money. That and also the convenience of credit cards because, oh, okay, I'll pay it when I get the bill. But if you constantly have a credit card balance, that means you're spending more than you're taking in. And that's a sign of trouble, and you should be aware of that. Companies are the same thing. If they're month to month, quarter to quarter, not taking in enough cash to cover their bills, and they constantly have to borrow, like a lot of companies have lines of credit. They get a certain amount of line of credit. University of Laverne has a $200,000 line of credit. So they draw on that credit during months like the summertime. In the summertime, like now, there's not too much tuition revenue coming in. All the tuition revenue will be coming in another month or so. So right now, they're probably either using cash reserves or using a line of credit, and that they'll pay that back once the revenue starts coming in the fall semester. So this is huge, especially in finance, because you don't want to borrow a lot of money because that's expensive. Interest, you got to pay it back. It draws on your cash. So managing your cash is huge, especially in financial management. And this is a good example of that. Because if you're borrowing money, you got to pay interest. So that's the nature of chapter. And it goes on to talk about budgeted financial statements and all that sort of thing. But the key thing that we need to get around with is, are we planning our business efficiently? Are we looking for those strategies of control, coordination, communicating with our departments and our employees, and motivating our departments to stick to their budgets? A lot of companies, if you're over budget for 2 or 3 quarters in a row, they'll fire you. And a lot of companies, if you don't meet your budget in sales, you don't meet your budget and costs, your job is in trouble. That's motivation. That's control. So for us as MBA students, we're strategists. We're running things. So the budget acts as a plan to way to manage the business efficiently. Jason, question.
So question, how do we and this probably isn't for this class, but when you have a budget assigned and managers are able to come in under budget, and they do that maybe 1 or 2 quarters just because of efficiencies or things of that nature.
Mhm.
Isn't it under the company's purview to kind of, if they see a continued decrease in the utilization of resources, to kind of adjust that budget? And don't we see people kind of take advantage of that and kind of like inflate costs just to make sure that they don't lose money for their budgets in following quarters or years, just to maintain
Yeah.
kind of like I guess you say a cushion or buffer just in case they do overrun?
You're exactly right. I mean, that happens in every business section, and it's up to the management, it's up to supervisors to have some control and communication saying, no, we're not going to inflate our budgets. We're going to be actual in our budgets. And those questions have to be asked on a routine basis. Secondly, you talked earlier about budget numbers changing, and that's why many companies institute a rolling budget. Changes from month to month, you adjust your budgets. Most companies don't like to do that because it creates confusion, but some companies, due to the nature of their business, they have to adjust their budgets on a monthly or probably a quarterly basis. And that's just depends on the culture, it depends on the type of business you're in. So again, the key thing there is control, evaluation. If we have a history of going under budget, we have a history of inflating budgets, and oh, it's December, let's spend out our budgets. We're not spending all our money, so let's go ahead and spend it. Let's have a huge Christmas party. Well, and that happens. But then it's up to the control aspects, the leadership of the company, to say, no, if you have extra, here's what they do. If you don't spend all your budget, I'll give you and your department a bonus for being under budget. Don't go out and spend it all. I'll give you a bonus for achieving efficiency. And that's where the motivation comes into. You motivate them by, if you manage your budget effectively, I'll pay you extra money. But at the same time, if you manage your budget ineffectively, you're either going to get a probation report or put on some type of system where you have to be more accountable on a week-to-week basis. So again, it depends on, it all goes on to leadership. I think all of you know that probably in every company that I've ever been associated with, or any company I've been asked to look at, the quality and the efficiency of the organization starts at the top. It starts at the top. Does leadership understand, can communicate, can effectively manage their business? And if they're not doing it, how do you expect the employees to do it? And that's a key. Matter of fact, I tell all my young undergraduate students who are going out in the workforce for the first time, it's important, yes, it's important to get a job, and I know you need to get a job, but also it's to find a company that in your mind, in the interview process, is run well. Is this a good company with a future because management has a good interpretation and are telling you in the employee interview process of what they plan to do and are very specific in understanding what their strategies are. If you go to a job interview and you sit down and interview and you answer all the questions and they say, well, do you have any questions? Yeah, could you tell me about your budget process and the accountability in your organization? Dead silence. I don't know about this place. Yeah, you might go to work there, but I wouldn't want to be there for too long, because if that's the attitude and that's the answer you get to that type of question, they're not going to be around much longer anyways. So you have to be aware of that. And Jason brings up a good point. It all starts at the top, or it all starts at the department level, the supervision level, the accountability level. If that's not being accountable, you got problems, because then people are going to take shortcuts. The motivation for efficiency is gone. One of the reasons why Doge is going on in the federal government with Donald Trump and was Elon Musk, he's not there anymore, is a lot of people think the government is run poorly, inefficiently. So they brought in these people from outside the government to try to figure it out. Now, in some ways, their public relations way they're doing it is not too right. But at the same time, that's kind of what has to be done. There's a lot of inefficiencies. And in private business or corporate business, those inefficiencies don't last too long, or they're going to be in fiscally trouble. So they clean that up, or they bring in new people. The government doesn't tend to do that. The motivation for accountability isn't there. Now, I know some of you might work in the government. You probably say, Mr. Hansey, don't pick on us. No, I'm not. There's a lot of inefficiencies in business. And so that's what the budgeting process tries to do, is sends a message it communicates that the leadership and the management is concerned about making this work. Because when everything works properly and you're planning correctly, you're going to make money and you're going to stay competitive with your industry. So know these definitions and the benefits of budgeting. We're going to take a look at a sample problem about budgeting next week in class, about what budgeting can do for you. But know that this is an important slide to know about budgeting. And also know about that cash management budget. Know these definitions from chapter 20, and we'll take a look at this next week in our class. Finally, for tonight, I want to look at this. And next week, as a prelude to next week, and I know you got a lot on your plate this week with assignment 4 and doing all that, and excuse me, and case paper analysis. But we're going to be heading into next week, and we're going to be looking at capital budgeting, finance, and how this is the end result of costing, financial statement preparation, budgeting. This is the end result, capital budget analysis. And this involves the future. How do we manage efficiently in the future to determine, are we going to make our returns? And that's what chapter 24 is about. It's about now looking at the future. Budgeting is looking at the future, but only 1 or 2 years out. Capital budgeting is looking at 10 years out, 20 years out. The depreciable life of a fixed asset. We buy a piece, if you can see it here, can't expand it, sorry. But we'll look at this next week. But here is a company that's going to buy a $1 million piece of equipment. It has a depreciable life of 10 years. So they're doing an analysis. Is this $1 million investment going to give us enough money, cash flow, returns over the next 10 years? So this is looking at long-term financial planning of a company. It's by the depreciable life of assets. Why do you buy a house? Why do you get a mortgage to buy a house in San Dimas? Well, I want to live in San Dimas to raise my family. They have a good school district, Bonita School District. I like it there. But one of the main reasons why you buy a house is because you know over the life of that house, it's going to increase in value. It's going to go up in price. That's your return as an investor. Well, one of the reasons why people buy houses in San Dimas or Laverne or Pasadena or Fontana or wherever is, yes, that's a nice place to live according to their budget and their means, but also it's a return on investment over time you're going to be making money off that house as it increases in value. And where you get that money is when you sell the house in the marketplace. Well, capital budgeting analysis combines both worlds of operating budgets in revenue and expense and long-term cash management going out many years. And this is the area that we're ending our course on next week as a filling way of determining how accounting and finance help to run successful, efficient organizations. So take a look at these as you get prepared for next week. I know you're doing a case paper, you're looking at the final and all that sort of thing. But this is where there's going to be a question on this in the final. So this is where we're heading to next week, is understanding how we look into the future with the management of the assets that the company owns. Not just operations, product costs, period costs, but actual investment in the future. And is that investment going to pay us back and grow the company? And that's what this is all about as we finish the course next week. Okay. So again, I will post this video lecture on the internet when I get it back, probably by later tonight. You have the assignment of the case paper assignment due this Sunday. In the week, this week, week 7, you have the final examination guide to help you prepare for the final examination, which we posted next Saturday and due August 3rd. So a lot of things going on. If you're taking other courses, or I know this is the summertime and we're getting close to the end of summer and this is vacation time for a lot of families, just know this: if you need extra time with your case paper, you have until August 3rd. But you have to have your final examination completed by August 3rd. There's no extensions beyond August 3rd. That's the official end date of this course. And I want to have the grades done to you, given to you that week before Mr. Hassey goes off on vacation. So that's why there's no extension beyond August 3rd. So plan accordingly. If you need any help as you get working on this, any last minute questions about your analysis in your case paper, I'll be around all week and this weekend. If you need help, email, a Zoom, you let me know and I'm around to help you. Am I missing anything? Any questions, anybody? Take a final look this week when I post the assignment 4 grades. What's your cumulative averages in the course? Where you stand heading into the last 45% of the course assessment. Know where you stand. If you got a solid A, which many of you do, or you're struggling, which some of you are, make sure what you have to do in these last 2 assignments to get maximum amount of grade that you need. Remember, and you all know this, and I'm sorry to bring it up, but in the MBA, you have to have a 3.0 average. You have to have a B average in every class. And so if any of you have some issues with that or any questions, look at your cumulative average, talk to me. Anything I can do to help out, please let me know. All right, everybody, I'll let you go at 5 minutes to the hour. The Dodgers are losing. What else is new? Have a great week, everybody. Need anything, let me know, and I'll see you all for our last class next Tuesday night. Adios.
Thank you, Professor.
Thank you, Professor.
Thank you.
Bye.
Professor Hassey, can I bother you for a second?
Sure, Jason.
All right, so, Mr. Hassey, I know I have a couple assignments that aren't in, and that's